Arthur Andersen did not collapse because it lacked clients. It collapsed because it lost credibility. For decades, Andersen was one of the most respected audit firms in the world. Its signature validated corporate financial statements. Its approval enabled access to global capital markets. But auditing is a business built on independence. Consulting revenues expanded rapidly. Client relationships deepened. Objectivity blurred. When Enron's accounting practices were questioned, Andersen's role became central. Investigations uncovered internal document destruction. In 2002, the firm was convicted of obstruction of justice. Clients departed rapidly. Within months, a global audit firm dissolved. The collapse was not operational failure. It was reputational capital evaporating under structural conflict between auditing and consulting. Arthur Andersen was founded in 1913 in Chicago. The firm was established by accounting professor Arthur E. Andersen. Its founding philosophy emphasized professional integrity. Early partners promoted the principle that independence was essential to auditing. Clients relied on auditors to validate corporate financial statements. Public investors depended on those validations. Through the early 20th century, Andersen built a reputation for strict accounting standards. The firm insisted that accurate financial reporting was a public responsibility. Corporate executives sometimes resisted these standards. Andersen partners were known to challenge aggressive accounting practices. This reputation strengthened the firm's credibility. Large corporations began selecting Andersen as their auditor. The firm expanded across major American business centers. Audit teams developed standardized procedures for financial verification. Documentation discipline became central to the firm's culture. Young accountants were trained rigorously in audit methodology. Professional skepticism was emphasized during field work. Partners reinforced the importance of independence from clients. Audit quality became the firm's primary asset. Throughout the mid-20th century, Andersen's influence increased. The firm audited major industrial corporations. It became closely associated with corporate America's financial infrastructure. Investors viewed Andersen's approval as reliable assurance. Banks accepted Andersen-audited statements when issuing loans. Capital markets increasingly depended on large audit firms. By the 1970s, Andersen had become a global organization. International offices opened across Europe and Asia. Audit methodologies were standardized across global networks. Training programs reinforced a unified professional culture. The firm's internal systems emphasized technical competence. Partners maintained tight control over engagement standards. Reputation became the central currency of the firm. Large multinational corporations sought Andersen's audit services. The firm's client list expanded across energy, manufacturing, and finance. By the 1980s, Andersen was considered part of the accounting elite. Industry observers referred to the Big Eight accounting firms. These firms dominated global corporate auditing. Andersen consistently ranked among the most respected. Its reports were accepted by regulators and investors worldwide. Audit opinions issued by Andersen carried institutional authority. The firm's Chicago headquarters symbolized professional credibility. Inside the firm, culture emphasized discipline and technical rigor. Partners advanced through strict professional evaluation. Clients trusted Andersen to provide objective financial scrutiny. That trust became the foundation of the firm's market position. Professional credibility functioned as Andersen's most valuable asset. Global capital markets relied on auditors like Andersen to certify financial truth. Institutional trust allowed the firm to expand its international influence. The Andersen name became synonymous with audit credibility. Structural takeaway: Arthur Andersen's rise was built on reputational capital created through disciplined independence and institutional trust. By the late 20th century, professional service firms began expanding beyond auditing. Clients increasingly demanded broader financial advisory services. Arthur Andersen responded by building a substantial consulting practice. Consulting assignments often generated higher margins than traditional auditing work. Corporate clients valued integrated professional advice. Executives preferred working with firms that already understood their financial systems. Consulting projects included technology implementation and strategic restructuring. These services strengthened Andersen's relationships with large corporate clients. Consulting revenues began to grow rapidly. Within the firm, consulting partners gained increasing influence. Advisory services offered opportunities for larger engagements. Audit work remained essential, but became less profitable by comparison. Partners began evaluating clients not only as audit engagements, but as broader business relationships. Corporate management teams often welcomed this expanded role. Consultants helped design financial systems used inside the same companies Andersen audited. These relationships deepened familiarity with client operations. The firm developed complex internal structures to manage these services. Audit divisions focused on financial verification. Consulting divisions focused on operational improvement and corporate strategy. Both divisions frequently served the same corporate clients. Revenue from consulting continued expanding through the 1990s. Consulting growth created internal competition for resources. Audit partners focused on maintaining professional standards. Consulting partners focused on expanding advisory services. Senior leadership attempted to balance these priorities. Formal internal rules attempted to preserve auditor independence. Regulatory frameworks also required auditors to remain objective. However, financial incentives were increasingly uneven. Consulting engagements generated significantly larger fees. Major corporate clients became valuable sources of recurring advisory work. Partners managing these clients gained influence within the firm. Client relationships became strategically important. Audit engagements often served as the gateway to additional consulting work. This structure reinforced long-term relationships with large corporations. Consultants worked closely with senior corporate executives. These relationships built trust and familiarity between advisors and management teams. Over time, the professional boundary between auditor and advisor became less distinct. Audit teams continued reviewing financial statements. Consulting teams simultaneously helped shape internal corporate processes. This dual model became common among large accounting firms. Competitors across the industry adopted similar strategies. Professional service firms evolved into multidisciplinary organizations. Large clients increasingly preferred single firms offering multiple services. From a business perspective, the model appeared highly successful. Revenue growth accelerated across the consulting divisions. However, the structure also introduced subtle tensions inside the profession. Auditing requires distance from client decision-making. Consulting encourages deeper involvement in corporate strategy. Balancing these roles required strict internal discipline. The stability of the model depended on maintaining clear professional boundaries. Structural takeaway. The combination of auditing and consulting created a profitable model, but it also introduced structural tensions between independence and client service expansion. As consulting revenues expanded, incentive structures inside the firm began to shift. Partners increasingly evaluated engagements based on revenue growth. Consulting projects generated larger fees than traditional audit work. Audit services remained necessary but produced lower margins. This difference gradually altered internal priorities. Partners managing high-revenue clients gained greater influence within the firm. Large corporate accounts became strategically valuable relationships. Maintaining those relationships became increasingly important. Audit teams sometimes faced pressure to preserve client satisfaction. Corporate executives preferred auditors who understood their business models. Long-standing client relationships created familiarity between auditors and management. Professional skepticism can weaken when familiarity increases. The auditor's role requires independence from client decision-making. However, consulting relationships encourage collaboration with management teams. These two roles began to intersect inside large professional service firms. Arthur Andersen was not alone in facing this structural tension. Across the accounting industry, firms expanded advisory services. The profession was transitioning from auditing institutions to multidisciplinary advisors. Within Andersen, consulting divisions generated accelerating revenue growth. Audit divisions remained responsible for regulatory credibility. Yet the financial incentives inside the partnership were uneven. Consulting partners often produced larger annual revenues. Those revenues influenced compensation and internal prestige. The partnership structure rewarded partners who expanded client relationships. Large corporate clients therefore became central strategic assets. Some engagements combined audit oversight with consulting assignments. This structure created potential conflicts of interest. Auditors were expected to evaluate financial practices objectively. Consultants were hired to improve and implement those same practices. Maintaining strict independence required strong internal controls. Formal guidelines attempted to separate consulting and audit functions. Internal compliance procedures reinforced professional boundaries. However, economic incentives sometimes moved in a different direction. Corporate clients preferred integrated advisory relationships. Executives valued firms that could solve multiple business problems. This preference strengthened the consulting model. Over time, the distinction between auditor and advisor became less clear. Professional skepticism requires distance from management influence. Consulting relationships encourage collaboration with management teams. The two roles operate under fundamentally different incentives. Balancing these incentives required strong institutional discipline. Inside Andersen, the firm continued expanding consulting services. Revenue growth reinforced confidence in the dual model. Externally, the firm remained respected across global capital markets. Internally, however, the balance between independence and client service was becoming more complex. The structure still appeared stable during the late 1990s, yet the underlying incentives were gradually shifting. Structural takeaway: when professional independence operates within a revenue-driven partnership structure, incentive misalignment can gradually weaken the safeguards designed to protect objectivity. During the 1990s, Enron emerged as one of the most prominent clients of Arthur Andersen. Enron was headquartered in Houston and operated in the energy trading sector. The company had transformed from a pipeline operator into a complex energy trading platform. Its business model relied heavily on financial engineering. Accounting treatment became central to how Enron reported performance. Arthur Andersen served as Enron's external auditor. The engagement placed Andersen at the center of Enron's financial reporting system. Audit teams reviewed Enron's financial statements each year. These reports were submitted to investors and regulators. Enron's reported revenues grew rapidly during the late 1990s. The company became widely admired on Wall Street. Financial analysts viewed Enron as an innovative market leader. However, Enron's accounting practices became increasingly complex. The company relied on special-purpose entities to manage certain financial obligations. These structures allowed liabilities to remain off the company's primary balance sheet. Understanding these arrangements required careful accounting review. Arthur Andersen's audit teams examined these financial structures. The firm also provided advisory services related to accounting implementation. Enron became one of Arthur Andersen's largest and most significant clients. The relationship generated substantial fees for the firm. Audit work formed one component of the overall engagement. Consulting and advisory services added additional revenue streams. Senior partners oversaw the relationship from Andersen's Houston office. Audit teams worked closely with Enron's finance executives. Meetings occurred regularly between Andersen partners and Enron management. Complex financial structures required ongoing discussion. Enron's accounting strategies attracted attention within financial circles. Some internal concerns were raised regarding certain accounting treatments. These concerns involved the interpretation of financial reporting standards. The structures themselves were not always immediately transparent to outside observers. Audit teams evaluated whether disclosures complied with existing accounting rules. Enron continued reporting strong earnings growth during this period. The company's market valuation increased significantly. Investors relied on audited financial statements to assess performance. Arthur Andersen's audit opinions validated those statements. Confidence in Enron therefore depended partly on Andersen's credibility. As Enron expanded its financial structures, scrutiny gradually increased. Financial journalists and analysts began asking questions. Regulators also started examining certain accounting arrangements. The role of Andersen as auditor became increasingly important. The firm's responsibility was to evaluate the accuracy of financial reporting. At the same time, Andersen maintained a long-standing professional relationship with Enron. The engagement remained financially significant for the firm. This combination placed Andersen in a structurally sensitive position. Audit independence required objective evaluation of accounting practices. Client relationships encouraged cooperation with management teams. These dynamics converged as Enron's accounting practices drew increasing attention. Structural takeaway: when a major client depends on complex accounting structures, the auditor's responsibility becomes more critical, especially when financial incentives and client relationships intersect. By 2001, scrutiny surrounding Enron's accounting practices intensified. Financial analysts began questioning the company's complex financial disclosures. Journalists investigated the structure of Enron's off-balance sheet partnerships. Regulators started reviewing the company's financial reporting. As the investigation expanded, Arthur Andersen's audit role drew attention. Government agencies requested documentation related to Enron's accounting practices. Audit working papers became central to the inquiry. These documents recorded how Andersen evaluated Enron's financial statements. Inside Andersen, discussions began regarding document management policies. Partners reviewed internal procedures governing audit documentation. Professional auditing standards required retention of key engagement materials. At the same time, firms maintained policies for routine document disposal. These policies allowed removal of non-essential working drafts. During the Enron investigation, Andersen personnel initiated document reviews. Staff began organizing files connected to the Enron audit engagement. Certain materials were destroyed according to internal document management policies. This process occurred while regulatory scrutiny was increasing. The timing of document disposal later became a central issue. Investigators examined whether documents had been intentionally destroyed. Attention focused on internal communications within the firm. Emails and memoranda discussed document retention procedures. Government investigators analyzed the sequence of internal actions. The question became whether document destruction obstructed the investigation. The Department of Justice began evaluating potential legal violations. The issue extended beyond Enron's accounting practices. It now involved Andersen's internal conduct during a federal inquiry. Audit documentation plays a critical role in regulatory review. These records demonstrate how auditors evaluate financial statements. If documentation disappears, regulators cannot reconstruct decision processes. Investigators therefore treated document destruction seriously. Within Andersen, senior leadership reviewed the situation. Legal advisors became involved in assessing the firm's exposure. Partners recognized that the investigation had escalated.
public attention began shifting toward the audit firm itself. Media coverage increasingly referenced Andersen's involvement in the case. The firm's reputation became tied to the unfolding investigation. Corporate clients observed these developments closely. Confidence in Andersen's independence began to weaken. Professional credibility had long been the firm's primary asset. Now that credibility was being questioned publicly. The investigation shifted from accounting interpretation to potential obstruction. This shift dramatically increased the legal risk facing the firm. The issue was no longer limited to Enron's accounting reporting. It now concerned Andersen's institutional conduct during a federal inquiry. The stability of the firm began to depend on the outcome of the investigation. Structural takeaway: when audit documentation becomes part of a regulatory investigation, internal document management decisions can transform a technical inquiry into an institutional crisis.
By early 2002, the investigation surrounding Arthur Andersen had entered the legal system. Federal prosecutors began examining the firm's conduct during the Enron investigation. Attention focused on the destruction of audit-related documents. The Department of Justice reviewed internal communications inside Andersen. Investigators reconstructed the timeline of document management actions. The central legal question involved potential obstruction of justice. Prosecutors examined whether document destruction had interfered with a federal inquiry. Internal emails and memoranda became part of the evidence. These communications described discussions about document retention. Andersen's leadership prepared a legal defense. The firm maintained that its actions followed internal document policies. Routine document disposal had long been part of audit file management. Draft materials were often removed once final audit files were completed. However, prosecutors focused on the timing of those actions. The Enron investigation had already become public when documents were destroyed. This timing raised questions about intent. Legal teams debated whether the destruction was routine or deliberate. The case proceeded toward formal criminal charges. Arthur Andersen was indicted for obstruction of justice. The indictment targeted the firm as a corporate entity. Legal proceedings began in federal court during 2002. The trial attracted national attention. The case involved one of the world's largest accounting firms. Financial markets monitored the proceedings closely. Corporate clients observed the legal developments with concern. Audit firms rely on regulatory approval to serve public companies. A criminal conviction could threaten that approval. Andersen's legal team argued that employees followed established guidance. They maintained that the firm had no intent to obstruct investigators. Prosecutors presented internal communications to support their case. Jurors reviewed the sequence of internal actions. Witness testimony described document management instructions inside the firm. The courtroom proceedings examined the firm's internal decision process. Observers recognized the potential consequences of the verdict. Professional credibility was central to Andersen's business model. The trial therefore carried significant institutional risk. Weeks of legal argument unfolded in federal court. Evidence centered on the firm's internal communications. The jury ultimately evaluated whether obstruction had occurred. In June 2002, the verdict was delivered. Arthur Andersen was found guilty of obstruction of justice. The conviction immediately altered the firm's legal position. Regulators and clients reassessed the firm's reliability. Professional services firms depend on institutional trust. Once legal credibility erodes, operational stability can weaken quickly. The conviction triggered immediate concern across Andersen's global client base. Structural takeaway: when a professional services firm is convicted of obstructing an investigation, legal liability can rapidly translate into institutional instability. Following the conviction, Arthur Andersen faced immediate commercial consequences. Corporate clients depend on audit firms to maintain regulatory credibility. A criminal conviction created uncertainty about Andersen's ability to perform that role. Public companies require auditors approved by regulators and stock exchanges. After the verdict, many clients began reviewing their audit relationships. Corporate boards initiated discussions about potential auditor replacement. Audit committees evaluated the regulatory implications of the conviction. Financial reporting deadlines created additional urgency. Companies needed auditors capable of issuing legally valid opinions. The Andersen conviction raised concerns about whether those opinions would be accepted. Regulators signaled that scrutiny of Andersen engagements would intensify. For many clients, the risk of continued association became significant. Large corporations therefore began seeking alternative audit firms. The transition process required transferring audit responsibilities quickly. Competitor firms prepared to absorb Andersen clients. The accounting industry still contained several large global firms. These firms had the capacity to assume major corporate audits. As clients departed, Andersen's revenue base began shrinking rapidly. Long-standing engagements were terminated within weeks. Some clients moved to competing Big Five firms. Others redistributed engagements across multiple audit providers. Announcements of client departures appeared regularly in financial media. Market confidence in Andersen weakened further. The firm's reputation had long supported its business relationships. Once that reputation deteriorated, client loyalty declined quickly. Partners inside Andersen attempted to stabilize the situation. Internal meetings addressed the accelerating client departures. Leadership explored strategies to retain key engagements. However, uncertainty surrounding the conviction made retention difficult. Corporate boards prioritized financial reporting stability. Investors expected companies to maintain credible auditors. Audit firms function as institutional gatekeepers in capital markets. When that gatekeeping role becomes uncertain, companies seek alternatives. Within months, Andersen's client portfolio contracted significantly. Revenue streams that had supported the global network declined sharply. Partners across international offices faced growing uncertainty. Many professionals began seeking positions at other accounting firms. Competitors actively recruited experienced Andersen staff. The movement of personnel accelerated the firm's operational decline. Client departures reduced engagement volume across offices. With fewer clients, the firm's economic structure weakened. The partnership model depended on stable revenue generation. As revenue declined, sustaining the global organization became difficult. The firm had not lost technical capability overnight. It had lost the confidence required to serve as an auditor. Structural takeaway. In professional services, once institutional trust erodes, client relationships can dissolve rapidly, regardless of the firm's underlying technical expertise. Arthur Andersen had operated as a global partnership network. Offices across many countries were connected through the Andersen brand. These offices shared methodologies, training systems, and professional standards. However, each national practice also functioned with a degree of legal independence. The global organization relied on a shared reputation for credibility. When the conviction occurred in the United States, that shared reputation was affected globally. International clients began questioning the stability of the Andersen network. Local offices suddenly faced uncertainty about the firm's future. Many multinational clients required uninterrupted audit coverage. If Andersen could not guarantee continuity, those clients needed alternatives. Competitor firms moved quickly to recruit both partners and engagements. Large accounting networks prepared to absorb Andersen operations. Some international offices began negotiating mergers with rival firms. Professionals evaluated whether remaining inside the Andersen network was sustainable. National partnerships had to protect their own client relationships. If the global brand lost credibility, local offices would also suffer.
Several regional firms began distancing themselves from the Andersen name. Negotiations started between Andersen offices and competing accounting networks. These negotiations focused on transferring personnel and clients. In some countries, entire offices moved to competing firms. Professional staff followed partners to new organizations. Training systems and methodologies were gradually abandoned. The once unified global network began fragmenting. Brand identity, which had linked the offices together, was weakening. Without shared credibility, the network structure became unstable. International coordination inside the firm became increasingly difficult. Central leadership attempted to maintain organizational cohesion. However, local partnerships prioritized their own survival. Corporate clients also preferred audit firms with stable global networks. The rapid client departures accelerated pressure on international offices. Each office faced the same structural problem. Audit credibility depends on the perceived reliability of the firm's brand. If the brand becomes legally compromised, every office inherits the risk. This dynamic pushed many international partners to separate from the network. Some offices joined other global accounting firms. Others reorganized into independent local practices. The coordinated Andersen structure gradually unraveled. Professional staff transitioned into competing firms across global markets. The global partnership that once operated as a unified institution fragmented within months. The collapse was not caused by operational breakdown inside each office. It resulted from the loss of shared reputational capital. Once the central brand weakened, the network's cohesion dissolved. A global professional services firm depends heavily on collective credibility. Without that credibility, structural integration cannot be sustained. By late 2002, the Andersen network had largely disintegrated. Most offices had merged into competing accounting organizations. Structural takeaway: when a global partnership depends on shared reputation, the collapse of central credibility can rapidly dismantle the entire network structure.
After the conviction, Arthur Andersen's operational viability deteriorated rapidly. The firm still possessed experienced professionals and established audit systems. However, credibility in the marketplace had weakened significantly. Public companies required auditors that regulators and investors trusted. The conviction introduced legal uncertainty around Andersen's audit opinions. Companies could not risk delays in financial reporting. Corporate boards therefore accelerated decisions to replace the firm. Large multinational corporations transferred audits to competing firms. These transitions occurred across energy, telecommunications, and financial sectors. Audit committees prioritized stability in their financial reporting processes. Without clients, the firm's revenue base declined quickly. The partnership model relied on continuous engagement income. As engagements disappeared, financial sustainability weakened. Internal restructuring attempts were discussed among remaining partners. Leadership explored potential options for preserving parts of the organization. Some proposals considered separating consulting operations from auditing. However, the speed of client departures limited these options. Professional staff continued leaving for rival accounting firms. Competitors absorbed many Andersen partners and employees. Entire engagement teams moved to competing firms. Clients often followed those teams to their new organizations. This migration accelerated the firm's institutional decline. By mid-2002, Andersen's workforce had begun shrinking dramatically. Global headcount declined as professionals transitioned to other firms. The Chicago headquarters attempted to coordinate responses across international offices. However, the global network was already fragmenting. Regulators across multiple jurisdictions monitored the firm's status. Public confidence in Andersen's audit capability continued eroding.
Financial markets had already adjusted to the firm's collapse trajectory. Corporate reporting cycles required dependable auditors. Companies could not delay financial disclosures while Andersen's future remained uncertain. The accounting profession therefore began absorbing Andersen's remaining engagements. 4 large accounting firms emerged as the dominant global auditors. Industry observers began referring to the Big Four. This restructuring reshaped the structure of the global auditing industry. Arthur Andersen, once part of the Big Five, had effectively exited the market. The firm's infrastructure remained, but its business model had collapsed. Legal appeals would continue for several years. However, commercial operations had already been dismantled. The partnership structure no longer had sufficient clients to sustain itself. Former Andersen professionals dispersed across the accounting industry. The brand that once represented audit credibility had largely disappeared. The collapse occurred within months rather than years. Operational capability remained intact, but trust had evaporated. Structural takeaway: in professional services, institutional survival depends less on physical infrastructure and more on the continued trust of clients and regulators. The collapse of Arthur Andersen forced a reassessment across the accounting industry. Regulators examined how audit firms managed conflicts of interest. The Enron case had revealed weaknesses in oversight mechanisms. Policymakers began reviewing the structure of the auditing profession. Public trust in corporate financial reporting had been shaken. Investors questioned whether existing safeguards were sufficient. In response, governments introduced new regulatory frameworks. In the United States, Congress passed the Sarbanes-Oxley Act in 2002. The legislation introduced major reforms in corporate governance and auditing oversight. One central reform was the creation of the Public Company Accounting Oversight Board. The new body was tasked with supervising audit firms that served public companies. Audit inspections became more formalized and systematic. Regulators gained expanded authority to review audit practices. The law also strengthened requirements for auditor independence. Certain consulting services to audit clients were restricted. This aimed to reduce conflicts between advisory work and audit responsibilities. Companies were required to strengthen internal financial controls. Senior executives became personally responsible for the accuracy of financial reports. These reforms altered the operating environment for audit firms. Accounting firms adjusted their internal compliance systems. Audit documentation requirements became more rigorous. Regulators expected clearer separation between auditing and consulting services. Professional training began emphasizing independence more strongly. Audit committees within corporate boards gained expanded responsibilities. They became responsible for selecting and overseeing external auditors. This change increased oversight of auditor-client relationships. The accounting profession also consolidated after Andersen's collapse. 4 large global networks emerged as dominant providers. These firms became known collectively as the Big Four. The reduction in major audit firms raised concerns about market concentration. However, regulators prioritized stability and oversight reforms. The industry adopted stronger internal governance procedures. Firms invested heavily in compliance and risk management systems. Audit methodologies were updated to reflect regulatory expectations. Global networks coordinated more closely with regulators. Professional credibility once again became the central asset of audit firms. The Andersen collapse served as a structural warning to the profession. It demonstrated how quickly trust could disappear. Institutional credibility had to be protected continuously. The auditing profession functions as a critical component of capital markets. Investors rely on independent verification of corporate financial statements. If that independence weakens, confidence in markets declines. Regulatory reform aimed to reinforce those institutional safeguards. Structural takeaway. The collapse of a major audit firm can trigger systemic reform when regulators seek to restore confidence in the credibility of financial oversight institutions.
The collapse of Arthur Andersen illustrates how professional service firms depend on credibility. Unlike industrial companies, audit firms do not produce physical goods. Their primary asset is institutional trust. Clients rely on auditors to verify financial information objectively. Investors depend on those verifications when allocating capital. Regulators rely on auditors to enforce financial transparency. This system functions only when auditors remain independent. Independence requires distance from client influence. It also requires internal incentives aligned with professional responsibility. When those incentives shift, institutional safeguards weaken. Arthur Andersen had built its reputation over decades. That reputation functioned as the foundation of its market position. Clients trusted the firm because it was perceived as objective. Once that perception changed, the firm's position weakened rapidly. The Enron investigation exposed structural tensions inside the firm. Auditing required critical evaluation of client accounting practices. Consulting relationships encouraged deeper collaboration with management. Balancing these roles demanded strict institutional discipline. Over time, the incentives associated with consulting expanded. Higher consulting revenues altered internal priorities. Large corporate clients became increasingly valuable relationships. Maintaining those relationships sometimes conflicted with strict audit skepticism. These tensions remained manageable while credibility remained intact. However, the Enron investigation placed the firm under public scrutiny. Document destruction shifted the issue from accounting judgment to legal conduct. Once criminal charges were introduced, the firm's credibility deteriorated quickly. A conviction accelerated that decline. Clients could not risk relying on an auditor facing legal uncertainty. Corporate boards therefore replaced the firm rapidly. Within months, the global partnership structure collapsed. The speed of the collapse surprised many observers. However, the underlying vulnerability had existed for years. Professional credibility operates like capital inside service firms. It accumulates slowly through consistent behavior, but it can disappear quickly when institutional trust is damaged. Arthur Andersen's technical capabilities did not vanish overnight. Its professionals continued working across the industry. What disappeared was the shared credibility of the Andersen brand. Without that credibility, the global organization could not survive. The collapse demonstrated how fragile reputational capital can be. Professional service firms operate within systems of trust. When that trust fails, institutional structures can dissolve rapidly. Structural takeaway. Professional credibility is capital, and when incentives undermine independence, collapse can occur quickly as structural pressure meets institutional trust.